Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. First and foremost, a big thank you to Fox Business, Maria Bartiromo, Bloomberg, CNBC for all including us in last week's dialogue, which ended on a very strange note. Late last week, liquidity coming into play. We'll start with rates in general. We look at 10-year yields in and around a little north of 433 last week on Friday. Before we did get some Fed speak, obviously the Wall Street Journal article talking a little bit about this dialogue within the Fed in terms of the speed in which we're going at now with rate increases. Consolidation off those levels. If we look to the UK market, not that we think things have completely cleared out, but some short-term stability, rates coming down there. In US space, if you look back not only 3 months ago, 10-year yields were at 250 around concerns over growth in the U.S. So with Friday's move, we moved close to 200 basis points within a very short period of time. We think consolidation here in and around those levels probably makes sense short term. Then we look at the terminal rate. We look at this article that came out on Friday. We listened to comments from San Francisco Fed President Daly, the Fed now in their blackout period, about the Fed having a pretty robust discussion at the November meeting about the magnitude of rate increases going forward. Look, the Fed is not going to stop. I mean, the fact that they are discussing moving down at some point from 75 basis point increments, at least to us, it makes a lot of sense. I mean, the Fed is not going to continue, certainly as they move into restrictive territory, they're not going to continue to increase interest rates. Certainly with lags in mind, they're not going to continue to increase interest rates at 75 basis point increments. So even at 50 basis point increments, and again, they're not stopping clearly, but 50 basis point increments are still very large increments. Certainly as we get toward 4.5, potentially 5%, the peak in terminal pricing for the Fed was a little north of 5%. We've come back with Friday's move, and we're a little inside of 5% now. But let's face it, we get another PCE deflator on Friday, expected to come in a little north of 5% in terms of core. You look at CPI, the core is even above that. You listen to St. Louis Fed President Bullard in terms of getting this funds rate to a level that exerts pressure down on inflation. It's pretty tough to fight 5 to 6% core inflation with the funds rate where it is right now. So the Fed clearly has more work to do. I think the dialogue and the discussion and the pathway forward will depend on inflation and how inflation evolves into 2023. But certainly we do expect the Fed to continue to do what they're doing, even if they do decrease the magnitude of the increases per meeting. And then lastly, the economy. I mean, certainly we see out of Europe, we see the PMIs, we see certain pockets of the U.S. economy, in particular the housing market, interest rate sensitive pockets of this economy slowing. And at the same time, we have a meeting from the ECB and the BOJ this week. The ECB expected to raise 75 basis points at the same time that the economy is showing signs of struggling. So we haven't seen this dynamic in a very long time, if ever. The key theme in the marketplace globally is still around inflation. But in the U.S., and we've been writing to clients, the Fed here has cover, and they have cover because of the employment market that's in front of us right now. We still have a labor shortage. And when you look at the labor market, you look at labor force participation, it hasn't moved in the direction that the Fed would like it to move in. And if you listen to comments from St. Louis Fed President Bullard again on Friday, he said explicitly and he said blatantly that the Fed has room to raise rates further here because of the employment market in the United States. On the ground this week, we have U.S. Treasury supply in the form of 2 years, 5 years, and 7 years. We get third quarter GDP, and most importantly on Friday, we get the Fed's favored inflation measure of PCE deflator, core PCE expected to come in around 5.2%. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.